There are traders 2 years into ICT who still can't tell you which way the market is going tomorrow. Not because they know too little, because they know too much. Order blocks, breakers, propulsion blocks, SMT, mitigation blocks, a chart so covered in boxes that no decision can survive it. Here's what nobody tells you. Every single one of those concepts is trying to show you the same thing: displacement. And there's exactly one tool that measures displacement mechanically, with no interpretation required: the fair value gap. So, in the next 12 minutes, I'm stripping the chart down to that one tool. You're going to get your daily bias from fair value gaps, your entries from fair value gaps, your stop loss from fair value gaps. And critically, you're going to learn how to tell a high probability gap from the ones that are quietly designed to trap you, because that filter is the entire difference between this working and this not working. No order blocks, no 2022 model, just gaps, highs, and lows. Part 1. A gap is not a pattern, it's proof. Quick definition, so we're on the same page. 3 candles. The middle one expands aggressively. The wick of candle 1 and the wick of candle 3 don't overlap, and the space between them is your gap. That's the mechanical part, and it takes 10 seconds to learn. Here's the part that actually matters. That gap only exists because one side of the market got overwhelmed. Price moved so fast that the other side never got filled. The gap isn't the signal, it's the receipt. And that reframe changes how you use it. When you see a gap, don't ask, is this an entry? Ask, who just got overwhelmed and where were they trying to reach? Because a large participant doesn't move price for fun, they move it towards something. A high, a low, a pool of stops. That destination is your draw on liquidity, and the gap is the arrow pointing at it. Bias, entry, stop, target, all 4 fall out of that one question. Part 2. The inverted gap and how bias actually works. Now, the single most useful thing in this entire video. If a gap is real, price is allowed to wick into it. What price is not allowed to do is close a body through it. The moment a candle closes clean through a fair value gap, that gap has failed, and a failed gap doesn't go neutral, it flips. That's an inverted fair value gap, an IFVG, and it's the fastest bias tool I know. Bearish gap gets closed through, you're bullish until proven otherwise. Do it on the daily, and you have a bias for the session before London even opens. Do it on the 5-minute, and you have an entry trigger. Same rule, different clock. And it gets stronger with context. If price sweeps a high or a low first, and then inverts a gap on the way back, that's not a coincidence. That's a reversal with the liquidity already collected. Sweep, then invert. When you see those two together, take it seriously. There's a second use for this that most people miss, and it's about being wrong quickly. Say your bias is bullish, and price trades into a bullish gap during the session. It should hold. If it closes straight through instead, the market has just told you your bias is dead in real time before your stop gets hit. Most traders sit frozen when that happens. You don't have to. You flip, and you take the move in the other direction. Part 3. The gap that isn't there. 4, 520. PHEN. 3. Kai gap heng suot hind. 4, 520. Here's a piece of information most people never learn to read. The absence of a gap. When price breaks a high or a low and leaves a fair value gap behind, that's the market showing its hand. Real force went through the level, and continuation is the base case. But when price takes that same high and leaves no gap at all, no imbalance, no displacement, just a slow grind through the level, that's not strength. That's a liquidity grab, and reversal becomes the base case. Sit with that for a second, because it means you can read intent at every single high and low on your chart with one question: did it displace or did it drift? That question alone will keep you out of most of the fake breakouts you've been getting caught in. And notice the pattern the chart falls into. Once you see it, price runs from a high into a gap, down to a low, leaves a gap, runs back up, high to gap, gap to low. Every leg has a destination, and the gaps are the stepping stones. Part 4. Consistency theory, the filter. So how do you separate the gaps worth trading from the ones that trap you? This is the filter I use, and it's almost embarrassingly simple. Look at the color of all 3 candles. If all 3 are bearish, that gap is one-sided. Sellers were in control the whole way through. No argument, no hesitation. Same in reverse. 3 bullish candles, one-sided bullish gap. Those are your high probability gaps. Now the two-sided version. Candle 1 is bullish, candles 2 and 3 are bearish. Technically, that's a valid gap by the textbook definition, and that's exactly the problem. There's a bullish candle inside a bearish move. That's not control, that's an argument. The market hasn't decided, and gaps built on indecision are where most of your losses live, because they look identical to the good ones if all you're checking is the geometry. I want to be precise here, because I'm not claiming this is a law. Two-sided gaps sometimes work. One-sided gaps sometimes fail. What I'm telling you is where the odds sit. And when you're choosing between 4 gaps on a chart at 7 in the morning, odds are the only thing you have. Check the 3 candles. If they're not all pointing the same way, move to the next one. If this is landing, drop a like. It genuinely helps this reach other traders. Part 5. Structural gaps and inflection points. Filter number 2. Location. A gap that forms in the middle of nowhere is just an imbalance. A gap that forms through a structural point, through a swing high or a swing low, is a break of structure gap, and it's the highest quality thing on your chart. The level and the imbalance are stacked on top of each other. So when price returns, you're not hoping for a reaction. You're leaning on 2 reasons at once. This is also where your stop loss finally makes sense. Instead of shoving it out to the last swing and destroying your risk to reward, you can place it just beyond the structural gap. Because if price closes through a gap that formed at a break of structure, your idea was wrong anyway. That's the whole point of a stop. Not a random distance, but the price at which the reason for the trade stops existing. And here's the flip side. If a break of structure gap does get inverted, you don't just exit, you turn around. That inversion usually produces the most violent move on the chart, straight to the next structural point. One refinement that makes this properly precise. Inflection points. Take the high or low that your gap broke through, and extend that level forward in time. Most people delete old structure once price has left it. Don't. Weeks later, price will come back, tap that exact line, and reverse. And when it does, you'll usually find an inverted gap sitting right there with it. Old structure plus a fresh inversion at the same price is about as clean a signal as this method gives you. Part 6. Breakaway gaps. Where the stop belongs. Last piece, and it's the one that protects money you've already made. Sometimes after a gap forms, price prints 3 candles whose wicks do overlap the opposite of a gap. That overlap is a redelivered and rebalanced price range. And in plain English, it means the market went back, filled what it needed to fill, and settled. If the move is genuinely continuing, price has no reason to trade below that range again, so that range becomes a wall. If you're already long from a gap below, you trail your stop to just under it, and your trade is now protected in profit, which, if you're trading a prop firm account, is the difference between passing and starting again. If you're not in yet, you have a fresh entry with a tiny stop. And if price does come back through it, that's your signal the continuation is over. 1 structure, 3 jobs. Part 7. Putting it together. Before the steps, one question I get constantly. Which time frames? Keep it to 2. A higher one for direction and a lower one for execution daily, in 5-minute, or 4-hour and 1-minute, whatever suits your session. The higher chart answers which way, the lower chart answers when. What kills people is adding a third chart. Because the moment you have three, you will always find one that disagrees, and you'll talk yourself out of the trade you already had. Here's the whole method in 4 steps. Step 1. Clear your chart. Fair value gaps, highs and lows. That's it. I'm not saying order blocks never work. I'm saying you cannot master anything while watching 6 things at once. Step 2. Get your bias from inverted gaps and from whether structure broke with displacement or without it. Displacement through a level means continuation. No gap through a level means reversal. Step 3. Filter every candidate through the 2 rules. All 3 candles the same color and formed through a structural point. If a gap fails either test, you don't take it, and most gaps will fail, which is exactly what you want. Step 4. Use the inverted gap for your entry trigger and the redelivered rebalanced range for your stop and your trail. That's bias, entry, stop, and trade management, all from one concept with nothing else on the chart. Close. Do not take my word for any of this. Open one chart, go back 3 months, and mark 30 gaps. Log whether each one was one-sided, whether it formed through structure, and what price did when it returned. 30 examples and you'll believe this, or you won't. Either way you'll know, and knowing is what lets you press the button without your hands shaking. Commit to just this for 2 weeks. Not this, plus 4 other strategies. Just this. If this simplifies something for you, subscribe and turn on the bell next week. I'm breaking down how to read the draw on liquidity, so you know where these gaps are actually sending price. And tell me in the comments how many boxes you're deleting from your chart tonight. Not financial advice. Trading carries risk. Manage your risk, 1 to 2% per trade. See you in the next one.